I got my Cub hat on. You have your New York hat on.
That's
Uh,
right.
we're all set here. One of the sessions yesterday, I forget which session it was, but we got talking about, in the team mentoring, we got talking about 2023 and some of the results and different things. I thought Tom had some, we just had a good discussion on that. And I thought it'd be good to have to come on and share. And then the second thing was we were talking about calendars. And Tom had come up with it. Tom is a mastermind at spreadsheets. I've seen some great, one thing, Tom, in the community over the years, a lot of people that are very good with computers. And I've seen some amazing what people can do with, do you use Excel? Is that what it is?
Oh yeah, it's all Excel. Yes.
Yeah. And some of the stuff, it's amazing. Um, you talk about a practical application, I guess you'd call it Excel, but it's amazing what you can do with it. So Tom, I thought it'd be nice. I haven't seen it yet. He told me a little bit about it.
Yeah, we just touched on it. We just touched on it briefly yesterday, but I can certainly show it today. We can maybe get a little further into the discussion.
Yeah, I thought maybe start out a little bit with, again, we were talking in the team mentoring to just, hey, share how, just give thoughts on your 2023 results, what worked, what didn't work, how you doing, what would you like to improve? And we did talk, at least what pops in my mind with a lot of people. Obviously, if you look up, I'll just show for a second here. If we bring up a price chart of SPX, and we look at the year, and again, this is through the lens of range-bound traders. If we look at the first, let's say we put this a year. If we look at the first 6 months of the year, if you ask range-bound traders, hey, did you do well the first 6 months of the year or the second 6 months of the year? So here, price chart, here's the first 6 months, here's the second 6 months. And the first 6 months, a little more, range bound, a little bit of bump here, a little bit of slower. And then you had this up until October, kind of this down movement. And then we started the historic, 700 points up in the SPX in 2.5 months. So obviously there's a tale of two halves you had, but what was unique to me is just to see, over the last 10 years, it wasn't the typical slowly uptrending market with some bumps, right? This was, you had some decent, some from, maybe the August area to end of October down, then you had some up. Beginning of the year, you had some down. But anyways, with that little bit of thing, Tom, give us your thoughts if you want to show anything, if you want to whatever. But
I can just give it, a quick rundown and sort of, my year and some observations.
Go ahead. You want to show anything or just talk?
No, not in terms of my trades. I'll just talk through it.
Okay, go ahead.
Just in terms of my overall year, I was profitable. I had a good year. I mostly trade, just to give people an idea, I mostly trade calendars and flies 18 to 25 days out. That's probably 90% of my trades.
Tom, let me stop you for 2 seconds. Let me just go backwards for just a few seconds. Maybe give folks a view of how long you've been doing this, how long you've been kind of with us. Just bring them up to speed.
Yeah, no, I mean, I did a little of that when I spoke a couple months ago, but I can touch base on that again today. I've been in the community about 18 months, right? So I started June of 22.
Yeah.
So it's about 18 months now. Prior to that, I had never traded a calendar or a fly.
Okay.
So this is all new to me. I had always managed my own money, and I consider myself an investor, but not range bound income trading, not calendars, not flies.
Okay.
Hadn't done that until I started taking your classes.
So you were more, what kind of trading were you doing before?
I mean, it was really more long portfolio type stuff. I've covered calls, cash secured puts, a
Yeah,
lot of just long stock mutual funds. The very, the typical thing you would see people invest in terms of a long portfolio, and not an active trader, not so much of an active
yeah,
trader.
which is,
Really
yeah,
more, really more investing. This is trading.
yeah, and yeah, the range bound part of the portfolio uh, is different. Yeah, but you know, I always recommend a long part of the portfolio. They're just, they can be complementary. But yeah, so you've been doing this about 18 months. Go ahead.
Yeah, I'd say 18 months I've been in the community. I started taking your classes June of 2022. And like I
Okay.
said, prior to that, I had never traded a calendar or a fly. So at the time, this was all new to me. I would say, for the first 6 months, I really just, for the most part, traded, whatever you were doing in class. I stuck with the class trades, managed them along with you.
Yeah,
And the first 6 months or so, I say I broke even. I won some, lost some. I was trading small, one or two contracts,
yeah,
really just learning the craft, getting familiar with the strategies. And, that was the first 6 months, I would
yeah,
say. And then beyond that, once I got past that and I got my feet wet, I really have moved away from the class trades and started doing my own trading. Just,
yeah,
as you talk about an independent craftsman, you talk about it all the time. So started, you know, my own trades, trading a little bigger, and I just got consistent. It just took me, I'd say the first 6 months, you're just learning everything. You just,
yeah,
there's so much to learn. Once you get past that and you get a good sort of foundation for your trading knowledge, at least for me, I got consistent. I started trading on my own, trading a little bigger, consistently getting bigger. And just, a key turning point for me where I felt confident in starting to put my own trades on versus just doing what you were doing in class was when I had trades on that it was down, I was able to manage them and turn them around. Right.
yeah,
You put on a trade, you're down 6-8% in the first 4 days. If you're a newer trader, that could be, that could get stressful, right? That could be
sure.
a challenge. And so for me, it was really, I noticed there was a trade, I'd say November, probably November of 22, where I had put on a fly and I was down very quickly. But I stuck with it. I'd managed it, stayed in it for like 3 weeks and turned it around into a profit. And the point I'm trying to make is for me, the turning point was experiencing adversity and being able to manage through that trade and turning it around into a profit. And having seen that for the first time, that was really a turning point for me because that's really when you learn how to trade, when trades go against you. And
Yeah,
that just, it really opened my eyes to what you can really do with this range bound income trading.
yeah,
That you have to know what you have to manage your position. You got to manage your risk. You got to be able to deal with adversity and trade goes against you. You have to have a plan, right? You got to think 2-3 steps ahead. What am I going to do if we go up? What am I going to do if we go down? And that again was like a turning point for me November, December of 22. And then last year I did well. Last year I was really consistent, started trading bigger and just, was confident that I had an idea of what I was doing by that point, and it,
yeah,
um, so in terms of my year overall for 23, I had a good year. My win rate, we talked about some of this yesterday in the team mentoring. A lot of the statistics that you referenced in the 10% class are really consistent with what I saw last year. Um, in terms of flies, like my win rate on flies was 91%.
yeah,
And you talk about roughly 75% as being sort of a target. For
yeah,
me last year, my win rate on flies was 91%. And my average DTE was 26. The average days in trade was 6. So that kind of is consistent again with what you talk about in class, where 75% roughly win rate, 20% of the duration you want to be in the trades. I found that over 80 flies for all of 2023. Consistent with what you teach and some of these general principles that you focus on in class, I found them to be true.
why do you think it was
Um,
up to 91 in butterflies?
I mean, I think it's just obviously that's the trade I've done the most of. It I'm most comfortable with.
Yeah, yeah,
I have a good feel for them. I'm able to effectively manage, and I think the biggest thing for me, just when we talk about flies versus calendars, they are very, very different trades.
right,
Okay, once you introduce the concept of mixed month spread, volatility becomes such an important, crucial part of the trade, crucial part of whether or not your trade is going to be successful or not. And flies, it's a lot easier. I just think, you're going to get your decay. The trade works differently. So my win rate's higher on flies. Calendars, you're dealing with skew. You're dealing with long and short options. You're dealing with mixed month spreads. the volatility can go up in one and down in the other and vice versa. And you can't predict it. You can't control it. And it just, for me, it creates more of a challenge. It's just understanding that. And so that's my win rate in calendars. I would say, I mean, it's high. It was high. It was 75%, but that's misleading because I had a good year. I made money. I'm profitable. My profit is coming from my fly trading. Calendars actually lost a little bit of money.
Okay.
Now, even though my win rate's 75%. So when I say win rate, you got to really, peel back the onion there and go, because one number by itself doesn't tell the whole story.
You'd
Right?
have
So
to
we talk
dig
about
down and almost look at the calendars. And I mean, the first thoughts coming to my mind, was it more, if you lost, I'm just thinking immediately, we're more on the downside, upside, or could you get any kind of commonality of the calendar?
the comment, and I'll tell you, so I did 80, let's see, I've got 80 flies, 44 calendars for the full year of 23. I said the win rate was 91 on flies, 75 on calendars. I actually lost money though on calendars, but I'm trading, I mean, the flies I'm trading like 4 times as much capital, and it's a much bigger piece of my trading. So overall, I'm profitable. In terms of sort of like a common theme as to where the calendars, where I lost and why I lost, honestly, it's really a couple things. Holding them too close to expiration, right, is really a big one, because with these calendars, the price of them can change dramatically in an overnight, seemingly, especially if you get in 10 days or closer in a calendar, the price can change very, very quickly. The volatility spikes on the short and it goes down or stays where it is on the long. It could be 8-10% in a day, in a 40-50 point move. And that is sort of the situation I got into a few times where, I didn't appreciate the risk.
Sure.
In those trades, and someone got too big. Common theme would be calendars too close to expiration and just getting too big with them and not appreciating the risk that I was really carrying in those trades at the time.
And Tom, I think you can make it. I mean, I think we were discussing this yesterday in our team mentoring, just getting, for me on any range bound trade, it's like if I could put up some kind of, unless it's an intentional thing, like you're going to do a trade on Monday of expiration and hold it a couple days, and it's intentional and it's much smaller size. But generally on your core trades, if you're, 15 to 40 days out, you don't want to go, you don't want to go on expiration, expiration.
This is,
it's just price risk. I mean,
this is something, this is just something I'm finding now that I have a good chunk of experience, that what's worked best for me is sort of that, 18 or 20 out to maybe 25-day trade, where, as opposed to say 15, because what I'm finding, especially more so with calendars, if you put on a 15-day calendar and you get a move, 40-50 point move in the first day or two, it's going to hurt the trade a lot more than if you were a week further out. 22 days versus 15. I'm finding it's a big difference. And
you're saying you'd rather be a little bit further out, like
I'd rather be a little bit further out, because I'm confident saying a week further out, I can manage those trades. I can deal with it. If I got to adjust early in the trade, I've done it successfully many times. The shorter duration trades, if I get a move, like, it becomes more challenging, because now you put on a 15-day calendar, we move 40 or 50 points the next day. Okay, that's fine. But by Monday, you're down to what, 12 days now?
Yeah.
15. So now, okay, now you're kind of getting around that danger zone, in my experience, where you get to 12, 11, 10, and it's more challenging for me. And I, as I start to trade bigger, if I have a $50,000 trade on and I'm down to 12 days and the P&L moves 8% in a single day, like, those are situations I'd like to try to avoid. And for me, avoiding that is just starting a little further out.
Yeah, I think you bring up some good points. I mean, I like calendars, but like anything else, they're a little more colicky to me than
because you can't. Once you introduce the concept of a mixed month spread, you're dealing with skew, and it's, correct me if I'm wrong, but it's just a function of market conditions, supply and demand, right? Insofar as the IV embedded in these options, and I can't predict it and I can't control it, but I have to deal with it.
Yeah. And I also think that, when you get into the world of calendars, I mean, I do think the most important thing, well, in choosing any range bound trade, it's not the volatility. It's, how's the market? It's price,
Of course.
always number one price, but number two, it is implied volatility. I mean, skews is different, but to me, it's still ultimately is the price of the volatility. But I think, whether you have 3 days, 5 days, 7 days, 14 days between the long and the short, there's a few more things. And I think there's other ways to skin the cat. What would you say is the one area in range bound trades that you would like to improve upon in 24?
It's just, I can tell you, I did have 3 trades in 23 that got away from me that I lost more than I should have. So that really, it took what could have been a great year and brought it down to a good year. So not letting trades get away from me, and just having a deeper appreciation for the risk I'm carrying in certain trades. And what I mean by that is specifically calendars. You get close to expiration, crazy things can happen. And just, I've learned from that experience over the last year, and just that's something I need to, just keep in mind. Don't repeat those mistakes. And something we touched upon yesterday, Dan, is just, I typically increase capital when I adjust a position, and I just have to be mindful, I think, of keeping my position sizes consistent. Because sometimes, I've had trades where I started 20,000, 30,000, it might turn into 60. I have other trades, maybe I start at 10 or 15 and it only gets to 20 or 25. And like, I'm trading all different sizes sometimes. And I think I need to be more disciplined and consistent with that. And just, that to me is the biggest thing. Just more disciplined and consistent with trade size.
I agree. Yeah.
And not number one, and just not letting, because I had 3 trades. I'll tell you right now, I had 3 trades. I lost 2 more than I should have. And just, you got to like stuff like that. They're mistakes. The other thing I want to say is that these 3 trades I'm talking about where I lost more than I should have, it's not because of the market. When I look back in hindsight, the position I had on those days and what happened, it's bad trading. It's mistakes. It's not the market. And that to me is very encouraging, because that's correctable.
Right. Well, I think that's the number one reason, and Tom hit it, why you need to go over your trades. But I think is like, I'll just say this as Tom is doing it. We have some team mentoring classes that we just started in August and September. And even, you try to match different levels and stuff. And in Tom's group, I would say he's the most experienced, but even I think Tom would admit, just the interaction with other people, the interaction and throwing ideas, it's better than interacting by yourself, right, Tom? When you say even
absolutely. Listen, you never know who you're going to come across, and they might think of something you didn't think of. That happens all the time. That's just, of course.
Well, even in the team mentoring, I could say everybody in there, whatever level they are, they're smart people. They've been smart in different areas. And so even if they're a beginner, they're coming up with questions like, well, I didn't think of that. How did they come up with that? But
of course,
So, well, go ahead, Tom. Share your.
If I share,
this is just a spreadsheet talk addressing skews of a calendar and just some observations Tom did. I think, as far as delving into all the implications of it all, or whatever, maybe we could talk another time. But Tom, go ahead and.
All right. So yeah, Dan, we touched upon this briefly yesterday in the team mentoring session. With volatility coming down quite a bit, say today versus where it was a year ago, I think I'm going to be doing a lot more calendars going forward than I have. And so over the last few weeks, I put this together just sort of as it's really a financial model I use to screen for potential calendar trades. And what does that mean? There's a function in Excel where you can extract real-time data from TOS and pull it into Excel, and then you can build potential trades off of that data. So that's essentially what this spreadsheet is doing. And if I highlight this section right here in the left part of the screen, all that I'm doing here is I've got different expirations, right? So Jan 12, 16, 17, 19, so on and so forth, right? And I'm pulling directly out of TOS what that specific option is trading at, right? And what the Greeks are, delta, gamma, theta, vega, and what the IV is. And this is for the Jan 12 4,700 strike call, just what this option is worth and what the Greeks are and the IV. So if you think about what you can do with this information, what I'm doing on the right side of the screen, which is this section, okay, I just have potential calendar trades set up where I'm going out 7, 14, 21, 28, 35 days to the short. And I have the calendar set up either 3, 5, or 7 days wide for the different expirations. And then over to the right, I'm showing if I was going to put on a particular calendar, I'm assuming I'm going to use $20,000 of capital to open the trade. This is how many contracts it would be, 68. And what would the Greeks be for that calendar? Okay, what's the delta, gamma, theta, vega, so on and so forth. I look at, in the last 2 columns over to the right, I'm showing theta as a percentage of capital. So what's the daily yield on a particular calendar? And then theta to delta, how many times my delta is my theta. These are just some, metrics I built into this spreadsheet. And it's updating in real time. So you can see the numbers changing. That's because as the market moves, as option prices change, this information updates. And, we don't have a lot of time today, Dan, and we just touched upon this briefly yesterday. I really wanted to, walk you through this and just get a feel for, whether or not you thought there was value in this. Does it make sense? I mean, it certainly makes sense to be aware of the skew and be aware of the IV and your different options in the calendar. It was really going to be a question to you as to whether or not, is there value in this? Does this create an edge potentially if you find the right skew in a given calendar?
I think, Tom, one thing what I'd like to do is, it's good just presenting it here. We have some pretty experienced people in my Thursday trading group, and we talked about the idea of skews. So I think that might be a good forum, maybe next Thursday.
Okay.
Thursday at whenever we meet at, I think, 12:15 Eastern.
Okay, we could do that.
Because that'd be good, because there's a lot of Steve and Dino and John and Jeff. I mean, we're going over this, and I think bringing it up in lieu of that would be helpful. And because as we were talking yesterday, I wasn't seeing this, but it's
I just want, just one other thing, and we can certainly do that. That might be a better forum just to get some more experienced people and see what they think, if they have any thoughts on it. But I just, at the top here, this is what I wanted to point out. This is like a great example of what I wanted to run by you. I'm focusing strictly on this at the top. Trade number 8, trade number 11. These are 2 different calendars that I was considering putting on. Yeah. So going out 21 days to the short or 28 days to the short, and then 5 wide. Okay. And trade number 8. So if you just look in this row, has a negative skew.
Yeah.
Negative skew, 17 basis points, and the yield is 1.3%.
Yeah.
That's 21 days out. If I go a further week out, this one's 21 days. This is 28. If I go out to 28, I'm getting a positive skew and a much better yield, even though it's further out in time.
Yeah.
And this is just an example of something. Trade number 11 looks like a much better trade than trade number 8 to me.
And when you say yield, where do you get the 1.9?
Okay, so yield is very simple. All I'm doing is I'm taking the theta, right? So let me put it maybe so everyone can see it better. So theta on this calendar that's the daily theta for 1 lot.
Theoretical, yeah.
And it costs $560 to put 1 contract on.
Yeah.
So 1080 divided by 560 is 193. So 1.93% is whatever, it keeps changing, obviously, as the market moves, is the daily yield. Now it's a theoretical number, as we know, especially with calendars. But just looking at
7 days further, and it's 7 days further out than the other one.
Yes, it's 7 days further out, and it's got the positive skew.
Yeah.
Now, January 31st is the Fed meeting. So I don't know if that, puts a wrinkle into this, but both of these options are post the Fed meeting, Feb 2 and Feb 7. And this might be, better. I don't know if you have any thoughts on it, or maybe it's better to share this with the trading group on Thursday and see if they have any thoughts.
I think it'd be good to kind of there's, because it's kind of good, you know, what would help me maybe just, yeah, go through maybe just a few examples just to get used to what we're looking at here at this point. So I could see,
Yeah, all I'm showing is, I mean, it's just maybe because you're used to looking at the toss option chain versus an Excel spreadsheet, so
Yeah.
it looks different maybe on the screen, but it's
Yeah.
really simple. All this is 4,700 strike. Put this in yellow, and it's calls, and it's SPX, something we do all the time. Right now, we're trading at 47.03. So this is an at the money calendar, 21 days out, 28 days out. And what is that, those spreads trading at, and what are the Greeks, and what is the skew, and what is the yield? That's all it is. You do this every day in class. You
and
just
you're
do it
looking,
on toss and
all right, and
not
you're
in it.
looking at this, maybe give a little bit of info. You're looking at this versus, you know, like it's harder to get a positive skew on a calendar when you're, you know, 21, 30 days or whatever out.
Yeah, and see, that
Maybe
was
give
something
the
I mentioned to
intro
you
to this.
yesterday.
Yeah, maybe give the, yeah, show, maybe you could see bigger skews on shorter term calendars and
Right here. So
why maybe you're going from, you know, 7 to 15 day calendars, why you're considering maybe a 21 day.
yeah, I mean, I would be like, based on what I'm seeing on this screen, I'm strongly considering putting on this 28-day calendar
I got you.
because of the yield and the skew. And you know, listen, you start getting on 15 days and closer. I wouldn't put as much credence in the skew. You know, the volatilities can change very quickly. You're gonna, as you know, come on, you can get very positive skews in short-term calendars.
Yeah.
But there's tremendous price risk, and you can't. I'm looking more in the 21, 28-day range, 3, 5, or 7 days wide, just to get an idea of, you know, is this a better, you know, quote unquote better trade? Is there an edge in this trade over, say, one with a negative skew?
Yeah, and I'm not
Is
saying,
what I'm trying.
yeah, here's my initial.
That's what I'm trying to learn.
Yeah, my
Yeah.
initial thought is this, that, you know, if you said to me, what's your number, you know, skews or skews, it's like, hey, how do I dress in Chicago in September? How do I dress in Chicago in May? How do I mean, it's a bad idea, but it is what it is. You know, you're going to have more negative skews on calendars further out, more positive skews closer in, and you could get into contango, backwardization and all that. And those are, I think those are things. If you said to me, what's the number one thing I look for in any range bound trade, including calendars? It's price. You know, is this, you know, do I see some two-way, you know, range bound? Number two, I ultimately want VIX or implied volatility levels in the lower end of the range. You know, I'd like, you know, for VIX, I like 12, 13, 14. Those are much more important to me than any kind of skew, right? Because I mean, the skews are what it is. I mean, they do tell you something, right? The more, you know, you could almost make a case, the more the positive skew, the farther away you should run from the reactor. Now, I know that's maybe a horrible analogy, but the point is, why is there a positive skew? You know, if you bring up the whole thing of earnings, why can you go in the day before earnings in Amazon or Apple and sell a 97 volatility and buy a 50? And it looks like on the Thinkorswim graph, you couldn't lose money if you tried to. Well, there's a reason. Because there's an expected big price move. You know, it's like I always say, you know, is, you know, that's why kind of using Evel Knievel, why I don't normally, why I would never buy usually straddles at earnings for the most part is because it's like Evel Knievel going over the, you know, it's built in that it's not going, you know, in other words, you needed to move like 50, 60 points in some of these stocks to break even on a straddle with the volatility going down. So I think bottom line is this. I think this does go into the fact of making someone a better craftsman and all that. Is it as important as the range boundness? Is it important in the ultimate volatility level? Because you know, if VIX were 20 and you say, I can do positive skews, I'd say, so what? You know, because you're at a high, you know what I mean? You're at a high number. But I think there's some good value to this, Tom. I think it's just digesting it a little bit and looking at it And I know there's smarter people than me in the training group, and we can digest it and help it. But I like it. I mean, I like.
Yeah, I mean, Dan, listen, I'm 100% with you. Like the price action, the size of the candles, where there's volatility, those are all prerequisites for me to even consider putting on a calendar on. I'm saying, assuming all those ingredients or the right conditions are in place, and it's a good time for a calendar. Does this then sharpen, help me find, quote unquote, better calendar?
I think it could zero you in to which strikes in which durations. I do. I think
Okay.
I think it, hey, there's 10 pieces of cheese on the floor. Which one should the mouse go after or something? Yes, and I think that's good. Sid said positive skew means higher. Positive skew means this: the implied volatility of the option you're selling is higher than the implied volatility of the one you're buying. So if you're buying an 11 volatility and you're long in a calendar and you're selling a 13, it's got a positive skew of 2. If you're going out to a 30-day calendar and I'm going to sell a 30-day calendar and buy a 37-day duration against it, it might be something like I'm going to sell a 12 volatility and I'm going to buy a 12.5. So to have a negative skew, if your long implied volatility is more than your short, it would be a negative skew type thing. And anyways, I think it might be good to cut it off here. I think I would, in the trading group, we'll go and I'll try to get that information out to folk. But Tom, thanks so much for sharing today. Appreciate all the feedback, and we'll go from there. So thanks again, Tom. Appreciate it.
Sure, you're very welcome anytime, Dan.
All right, thanks. Bye-bye.